computer. Hello, my name is Sean Tull. I'm here with Rising Business Solutions, and I welcome you to our Zoominar on how to create a tax-free retirement and how to create a tax-free savings for yourself. I know this is a very important topic, even right now with all the things that's happening in the world, but it's always a very important topic. And we're going to go over some things today on how to build that right now in today's age. So one of the things that we want to let you know as Rising Business Solutions, we are committed to helping people make informed choices to overcome today's challenges. Those challenges are a lack of financial education. So many people are not been taught about finances. They're living above their means. They have insignificant insurance protection. They have amazing debt. And so also all that leads to poor savings habits, including retirement planning. And we want to give you solutions to those problems. Yes, solutions, right? So one of the things that we're focused on in this particular webinar is retirement. And this is just some statistics that is very, very important for people to know. At the age of 50, that's where a lot of people start thinking of retirement a lot more. But you know what? You need to really start thinking about it a lot further ahead than that. However, because of the different things that we're all facing, we're slow to plan. And because of that, almost 75% of the population, actually even more, I think, after COVID, don't have $5,000 put away towards retirement at the age of 50. And that's a devastating challenge if you want to retire in your 60s, right? And then if you look at that, at age 65, actually, it goes all the way up to like 98% of people are not successfully retired. 45% depend on relatives, another 30% depend on charities, and then there's another 23% actually still working. And those numbers actually in that area, the 98%, they're increasing. I think more and more people are still working past 65 there. Now I'm looking to retire at 75. That's not the American dream, right? That is not what we all wanted to have when we started, going to school, high school, making that plan and doing that. That is actually a nightmare retirement, right? The nightmare, what's the nightmare? The nightmare looks like this: when you're not able to travel and you're getting sick, and then you have to sell your home, have to go back to having a job, or you never left your job, and you're just leaving a legacy of debt. And when you pass away, there's no inheritance, there's no positive passing of possessions. There's actually people have to do things like GoFundMe to actually put you in the ground, right? I mean, it's a horrible, horrible situation that so many people are starting to see themselves in. And what we want you to do is not have that nightmare. We want you to be living the dream. What's the dream? The dream is being able to do what you want, when you want, whenever you want, as long as you want, right? And that being able to travel, able to have freedom to help people, to do things, to actually maybe live out some goals that you have, and just even giving back to society, giving back to your community, giving back to your family. That is the dream, right? That's the dream that I believe everyone can attain if you make some plans. It's never too late to make the right plan. You're never too late to make the right plan. So what is the right plan? Let's talk about that retirement planning. And one of the first things I want to start talking about is your financial independence number, your FIN number. You might never have thought about that before. What is your financial independence number? And one of this example, let's say you wanted to live off of $100,000 a year, and you're thinking like, hey, look, I at least want to do that for the next 25 years. That means you need about $2.5 million to pull off of every single year to be able to live that out, right? That's something as a goal. I think this is personally, I believe that's something needs to be said and talked to young people coming out of college and say, hey, what's your retirement number? What do you want to live off of? And here's the thing. Now you have a destination to shoot for, and you can start to see, is my savings matching that? So I want you to think about that. How much money would you feel comfortable living off per year? Whatever that number is, 50,000, 25,000, 200,000, whatever it is, and how close are you to having that type of money saved if you're going to live another 25 or 30 years in your retirement place, retirement position, right? So that's how we want to build that up. Now, there's some things that you have to face if you want to build wealth. If you want to build wealth for retirement for any reasons, right? You have some things that you have to make sure that you're dealing with and you're winning at. And one of them is called compounding interest. Compounding interest is something that you have to win at. By the way, everyone is at the mercy of this rule. The rule is called the rule of 72. If you never heard of it, Albert Einstein called that rule the eighth wonder of the world. And he said, whoever understands it earns it, but whoever doesn't pays it. And the rule of 72 is in everything that we do and use to build our money, right? So what the rule says is you take 72, you divide that by your interest rate, that will give you the number of years for your money to double. So 72 divided by your interest rate will give you the number of years it would take for your money to double. Now, why 72? I don't know. That's by smarter people than me, but I just know this is what everybody uses. So let's kind of give you that example. Let's say you was earning something at 4%. Well, that's cool. So if you was earning 4% and you take 72, you divide it by 4, that means every 18 years that money will double. So if you had $10,000, let's just say, 18 years later, if you was gaining 4% every single year, that money would double to $20,000. And then another 18 years will go by and that money will double again to $40,000. So let me ask you, if that was your money right there, and let's say you're age 65 and you have $40,000, do you feel that's enough to retire on for the rest of your life? If you're like me, I'm going to say, hell no, right? So, yeah, but that's the challenge that we have if you was getting that. And let's just be clear, the banks is not even giving you that. They're giving you less than that. So let's look at what if we're getting other retirement plans, right? Or something that could get us closer to 12%. Well, then that means your money will double every 6 years. Same example, $10,000. At 6 years later, it'd be at 20,000. Another 6 years, it'd be at 40,000. Now, if you're looking here, you see at 41, you have 40,000. Compare at 65, you have 40,000. And you might think, well, okay, it might be 3 times as much, right? 40,000 times 3, maybe like 180,000. But no, it's going to be a lot more, because if you look at this again, at 47, going to be $80,000. At 53, is $160,000. 59 would be 320,000. And then when you hit age 65, you're going to have $640,000. And wouldn't you say that's a little bit better than $40,000, right? It's a little bit better, right? It's actually $600,000 difference. And who wants to miss out on that $600,000? And this is the thing, right? Is that the rate of return going to directly impact your money? It's not the only thing, but you have to get the best rate of return on a consistent basis. That makes sense? Everybody say yes, right? So what's stage number 2 or item number 2? You have to reduce taxes. And what we're talking about today is building tax-free money and tax-free savings for your retirement or for just saving money. You want to do that because there's 3 ways to save or have your money be taxed. Either it's taxed right now and forever, I call it, now and forever, right? That's your savings account, your CDs, your stocks, mutual funds, even in real estate or things of that. If you put your money in there, that means it's taxed when you put it in, and taxed as it grows. When you take it out, you pay, you pay a tax again, right? So you're always taxed, okay? Now, there's nothing wrong with that. It's a scenario that you might need to place some money in, but you also want to have some money in what we call tax later strategies. That means right now it's not taxed. You put it in money in places where it grow tax-free, but when you go use the money, you still have to pay some taxes, right? But right here, that means that's like your 401ks, your 403bs, your IRAs, your pensions, your TSPs, right? Even Social Security falls into this category, which means that a lot of this is taxed at income levels, right? And let's just kind of look at this, where a lot of people, a lot of financial experts is looking at and saying, hey, we have to increase our taxes if we're going to keep our country growing. And guess what? Right now, we've been in a very low tax situation. I know sometimes we don't feel like it is, but it is. We're in a very historically a lower tax situation and most likely it's going to go up. So here's the thing, you need to have some things that are going to protect you from both of these scenarios, either tax now or tax later. And that's what we call tax-free. In tax-free areas, it's called Roth IRAs, or now you have Roth 401ks, municipal bonds. This 529 plans for college education, but 7702 plans where I'm going to focus on, because that's a IRS code that allows you to put money away. Again, tax-free growth and also tax-free usage. And that's where we're going to focus on today. And by the way, guess where wealthy people want to have their money at, right? Tax-free, but they have it on all three, but they really want to have it in tax-free, right? So this is something that anyone can use, because look at how taxes impact your money. We just saw how if you was in your interest rates, and your interest rates, I mean, was low. Not only that, now let's just say you did a good job accumulating money, and now you're going to have to use it, and you had $1 million at 33%. You're going to lose $330,000, which means you really only have $660,000. So if you was planning off of $1 million and you have only $660,000, that's a huge deficit. Would you all agree? Absolutely, right? So that means that you have to build your retirement, you have to build your savings, and for whatever reason you want to use it to be able to avoid taxes legally. Here's the thing, right? There's another thing you have to do. You have to reduce risk. And right now, this is a big and huge area, because right at this moment, right as we're talking, you have the whole problem and the war that's going on with Russia and the Ukraine, and it's affecting the market. The market has been at least 10% down from the month before. If you're hearing this in the future, these things happen all the time. You never know what's going to happen to impact the market. So you have to protect yourself from risk. I'm just going to talk about that, the impact of risk on your money, a loss of the market loss on your money. So let's say you had $100 and you lose 50%. Market went down 50%. I have done that before, right? Let's say you did that. So now you went from $100 to $50. Now you say, well, how do I get back to $50? Well, I have to gain, interest, right? Now, if the percentage you grew 50% back up, you went from $50, you will only gain $25 more. That makes sense. So that means you only have $75. You still didn't make it back to where you was before. You still a $25 short. So that means you will actually have to gain 100% growth in the market again, just to get back where you was. Now, last time when we had this in 2008, it took almost 8 years for that money to come back like that. Again, guys, when you are looking at this, and you're planning something that's going to be in a retirement, and some of you all might have money in an old 401k or old 401b or old TSP, and you have that money that's staying there, and it's getting impacted by what? Market loss. And you have no money going into fund it anymore. You need to start looking at rolling over or moving it into better and safer areas, right? So we're going to talk about some things that could really impact your money. And we're going to focus right now on that IRS code we was talking about, right? IRS code 7702 tells you that, hey, any money connected to life insurance grows tax-free growth, and also when you use it as tax-free usage of that money. So this is very important, been used again since 1985, but actually the principle of this had been used even decades and decades before. So here's the thing, there's a lot of books out there. I'm going to tell you to go back and go and read it, go and check them out, but you can go and learn about this too. But we want to show you a concept that can really impact your money. And what it's doing is taking life insurance, but really making it as a savings plan. The life insurance isn't our focus. The life insurance just gives you an umbrella to protect your money from taxes. So you get life insurance that protects you if you die too soon, if you get too sick, right? And you get that insurance. But the savings is what we want to focus on, because you're going to get guaranteed growth plus dividends. Guaranteed growth plus dividends. And we're going to call this infinite banking concept. And this infinite banking concept is allowing you to have a floor where you at minimum don't get 2% or better, depending on the company. And you can gain all the way up. Actually, there's no real ceiling, but what we've seen is as much as 10% growth on your money. Isn't that amazing that you could have that? So having a 10% dividend growth plus 2%, that's like 12% growth. Guys, this is amazing. And I want you to see how this could work with you. So for example, let's say the index was like the market, and that market going out there and doing that, if you had a 401k and grew 10%, your 401k grow 10%. There's a program out there or insurance product called IULs. You go that which have a floor and a ceiling, and that goes at 10%. IBC would be at 10% growth too. Their index, let's say, went up 20%. Your 401k could go up to 20%. It's unlimited growth. Your IULs usually have a ceiling at 15%. And in this example, I'm just going to say, hey, the dividends was still at 10% at growth at this time. What with the results there? But let's just look at the market goes down and you had a negative 20%. Your 401k going to mirror that. It go down negative 20%. Your IUL usually have a 1% floor, but what we see is the IBC products and that we're showing this usually have a minimum somewhere between 4 to 5% that you're getting. I mean, I have never seen them not give a dividend growth less than 5%. So that's on top of the guarantee. So that's powerful in the last 20 years. And then let's say it was like negative 50% in the market, your 401k going to just mirror that again. IUL get you that guaranteed 1%, but again, IBC 5%. So if you're looking at that, your IBC product will gain 30% growth versus 27% with IUL, which is still good, or negative 40%. We nobody want to be there, but so many people have been there with their 401k. They keep on looking at their 401k and saying, this is not okay. How come it's not growing money? Because you're constantly losing money a lot of times in your 401k if you don't know what to do. Not saying that 401k is bad, I'm just saying that a lot of people have lost money in their 401k because they don't know what to do. So now that you saw that, let's talk about supercharging that retirement, because one of the things that we do here, and we show you how to use your expenses and turn it into a way to boost your earnings. So this is taking money you was using anyway and showing you how you could funnel it through your insurance policy to still pay your bills or your expenses, but be able to boost your retirement to make more money, earn more money. Because remember that rule of 72, you want to have that on your side. For example, mortgages, car notes, credit cards, loans, rentals, household expenses, and so on. All those things are expenses. And those expenses drag your money, right? But what I mean by that, so you have your money, you put it in a bank, you go pay all your bills, and guess what? Now that money is gone and it's not earning any more interest. That makes sense. Your money, when you spend your money, that money cannot earn any interest for you, right? Of course, when you had it in a bank, you wasn't care anyway because what you was getting less than 1%. So you was like, hey, I wasn't earning anything anyway. But what we're going to do is show you something that's amazing. This is amazing technique. We call it turn your liabilities into assets. We're turning your expenses into cash. Look, that's where your money, you go through your personal banking policy, which gives you life insurance, living benefits, cash value. We're going to talk about that cash value, increasing your estate value. And that old money earns interest, building tax-free. So that's a new asset for you. It's amazing. It's an amazing technique that we really want you to come back and get back with us so we can explain and show you an illustration how it will work for you. So then what you do is take a loan, and this is an amazing thing in this loan part. I was just going to say, you make money off the loan. Absolutely. So that's the key. You're making money off the loan. So even though you're taking a loan, it's actually still gaining money off of that loan. And then you go put it back in the bank and you still pay your bills. Now, guess what? That gives you new money to do things with, even though you use the money that you was going to use anyway, but now you have new money to do more things with, for savings or building to retirement or whatever you want. You can use that. And so the question is, does it make sense to pay the cost of insurance so that your money can always earn interest? As so many business owners, so many individuals have said yes to this, and seeing this technique so that they could grow and take advantage of something that they was losing at, which is building savings, and now become a winner at. And you can too. So here's the thing, right? We call this the prize position of savings. And this is actually basically becoming your own banker, right? Why have the banker control you when you could control your bank, your own bank? That'll help you eliminate debt. Imagine having more money, tax-free money to eliminate your debt. And if you eliminate your debt, you could save even more, right? You could build capital or have emergency funds for those emergencies that always come, always happening. Or you could grow money tax-free for the future, like retirement. and build your retirement. Again, this money cannot be seen by the IRS, so you will have that money there to build and take from for your future. And then you could even invest money with safety, because that money would be there that you can invest, but the principal still will be growing interest, even though you go out there and invest, and maybe you can find even better rates of returns, but you can do it now safely. And we want to show you how to become your own banker with this ultimate wealth strategy. This ultimate wealth strategy has been around for quite a while, and people like Ray Kroc or people like Walt Disney have used this to start to build their empires. Pamper Chef, even Stanford has used these techniques to start to build their school. There's 80% of CEOs use techniques like this to help build their wealth. Wealthy people, and like I showed you in those books, all access this amazing program so they can win with their money. But the cool thing is, anybody can use it. So I want you to think about this as we wrap up. Does this information make sense? Does this information, do you see value? Does this make sense, and do you see value? If you did, I want you to get back with the person who invited you. Do you think that others need to see this information? If you do, you need to get back with the person who invited you. And could you see how this could help you and your family? And I'm sure you do. You need to get back with the person who invited you or gave you this video. I'm telling you right now, I've seen this, I've used this, and I know this program works. So I want you to take the opportunity and start to change your future, change your retirement, change your savings, and start from being at the zeros to being a hero. And you can do that at any time you want. Now, with that, guys, I hope you have a great day, and we will talk to you later and see you soon.